All right, let's talk about the invisible forces that control, well, pretty much everything. We're going to pull back the curtain on why things cost what they do, from your daily coffee to that plane ticket you've been eyeing. Let's dive right in. Have you ever noticed this? One day, your favorite latte is a certain price, and the next, it's just a little bit more. Or, trying to book a flight in December costs a fortune, but in February, it's a total steal. What is going on there? It's not random, I promise you. It's actually a story. And this story has two main characters. On one side, you've got people like you and me, the buyers. We have our wants, our needs, and of course, our wallets. And on the other side, you've got the sellers, the people actually making the stuff. The way these two groups interact, this kind of dance they do together, is what sets the price for literally everything. So let's get to know these two groups a little better. I mean, who are they really? In any market, doesn't matter if we're talking about laptops, coffee, or even babysitters, you are always going to find these two sides. Okay, so on team one, we have the consumers. That's us. We're the ones buying things. And in the world of economics, we say that consumers create demand. Then on team two, you have the producers. These are the companies, the entrepreneurs, the people making all that stuff available for us to buy. They create supply. Demand and supply. Buyers and sellers. That's it. That's the core tug of war we're going to break down. Let's start with our side of the story, the buyers. What makes us do what we do? It really all comes down to understanding this incredibly powerful force we call demand. So what is demand really? Here's the key. It's not just about what you want. It's about what you are both willing and, crucially, able to buy. Like, I might want a private jet, but unless I've got millions of dollars just lying around, I'm not actually part of the demand for one. It's that powerful 1-2 punch of desire plus the ability to pay that actually counts. And this leads us to a super simple, fundamental rule about how we behave. It's called the law of demand. Honestly, just think of it like a seesaw. When the price of something goes up, our desire to buy it goes down. But the second that price drops, suddenly we're way more interested. It's this simple inverse relationship, and it just makes intuitive sense, right? I mean, who doesn't love a good sale? Now, there's a little asterisk here, a really important detail. For this law of demand to work so perfectly, we have to pretend that nothing else in the entire world is changing except for the price. It's kind of like a science experiment, We're just isolating the pure effect of price on our decision to buy something. So this seesaw effect has a name in economics. We call it a negative relationship. And it's exactly what it sounds like. Just like that seesaw, when one side goes up, the other side has to go down. Price and the quantity we demand are always moving in opposite directions. Okay, you gotta stick with me here, because this next part is maybe the single most confusing thing for people at first. A change in quantity demanded is just you reacting to a price change. So the price of coffee drops and you decide to buy more. You're just moving along the seesaw. But a change in demand is when the entire seesaw itself moves. Like, let's say you get a big raise at work. Now you might buy more coffee even if the price didn't change at all. That is a totally different thing. That's a shift in demand. So what kind of things can move the whole seesaw? Well, these are those other factors we were ignoring a minute ago. Things like your income changing, or a new fashion trend that makes something suddenly super popular, or maybe even a rumor that the price of something is about to skyrocket, so everyone rushes out to buy it now. These are the big game changers, the demand shifters. All right, so we've got the buyer's playbook down. Now let's flip the script. Let's look at the world from the seller's point of view. And we're about to see their motivations are the complete opposite of ours. Let's get into the rules of supply. The law of supply is basically the mirror image of the law of demand. For a producer, a higher price isn't a turnoff. It's a big green light. It's a signal that says, hey, make more of this stuff. You can make more money. And a lower price? Well, that's a red light, telling them to ease off the gas. So this creates what we call a positive relationship. Unlike the demand seesaw, where things move in opposite directions, here, everything moves together. Price goes up, the amount they're willing to supply goes up. Price goes down, the amount they're willing to supply goes down. They're moving in lockstep. So check this out. We have buyers who always want lower prices, and we have sellers who always want higher prices. You can feel the tension, right? So what on earth happens when these two powerful opposing forces finally meet in the middle? You can actually picture this in your head. Imagine a line sloping downwards. That's us, the buyers. Now imagine another line sloping upwards. That's the sellers. These two lines are on a collision course, and they are guaranteed to cross at one single point. And that one magic intersection point? That's called market equilibrium. It is the market's sweet spot. It's the perfect price where the amount of stuff people want to buy is exactly the same as the amount producers want to sell. Nobody's left wanting. The market is perfectly balanced. It's happy.
But what happens when the price isn't at that sweet spot? Well, if a hot new video game is priced too low, what happens? Stores sell out instantly, right? That's a shortage, and shortages push prices up. On the flip side, if that same game is priced way too high, it's just going to sit on the shelf collecting dust. That's a surplus, and surpluses force prices down. The market is this incredible self-correcting machine, always pushing back towards that perfect balance point.
Okay, theory is great, but let's see how this stuff actually works out in the wild. Remember those shifters that can move the entire demand or supply curve? Let's walk through a really cool real-world example. So picture this. In 2005, there's a huge baby boom. Lots of babies are born. Now fast forward 5 years to 2010. All those babies are now 5-year-olds who need babysitters. What just happened? A massive shift in demand for babysitters. With the same number of teenagers available to do the job, you get a shortage, and the price, the hourly rate for a babysitter, goes through the roof. But wait another 10 years. Now it's 2020. Those little kids are now 15. They don't need babysitters anymore. They are the babysitters. Suddenly, the supply of babysitters explodes. And what does that do? It creates a surplus, and the price of babysitting comes way, way down. See how that works? So we've seen how what we want as buyers and what sellers want to make come together to create this thing we call a market. We've seen how prices get set and why they change. Let's put a bow on this. From now on, when you see the price of gas jump overnight or notice that avocados are suddenly cheap, you won't just see a price tag. You'll actually be able to see those invisible forces of supply and demand pushing and pulling against each other. You can see the market constantly moving, always trying to find its balance. So here's a little challenge for you. Think about one thing you buy where the price has changed recently. Now that you've got these tools, can you guess what happened? Was it a shift in supply or a shift in demand? The answer is all around you. Thanks for digging into this with me.